Before we dig into the crises themselves, we need to understand the stage on which these dramas unfold. For centuries, money hasn't just been a tool, it's been a weapon, a lever, and a system of control. From the early merchant banks in Venice to the rise of central banking in Europe, the financial system has always been designed to concentrate power. Key figures like the Rothschilds in the 19th century, J.P. Morgan in the early 20th, and today, megabanks and private equity giants all share one thing in common. They thrive in volatility. While ordinary people lose homes, jobs, or savings during crises, these players often acquire assets at a discount, restructure debt in their favor, or reshape policy to secure dominance. And here's the twist you may not expect. It isn't always about malice. Many of these mechanisms are built into the system itself. Crisis, it turns out, is not an exception. It is a feature. Let's rewind to understand where it all begins. Most financial crises start with three common conditions. Excessive leverage. Individuals, corporations, and governments borrow far beyond their capacity to repay. Financial innovation without oversight, new instruments from derivatives to mortgage-backed securities, are created faster than anyone can regulate. Moral hazard. The implicit belief that losses will be socialized, bailouts, while profits remain privatized. Take the 2008 global financial crisis. It began with the U.S. housing bubble, fueled by cheap credit, aggressive lending, and complex financial instruments. Banks bundled risky mortgages into securities, sold them globally, and bet on continued housing appreciation. When the bubble burst, trillions evaporated overnight, but the key players were already positioned to benefit from distressed assets, government bailouts, and consolidations. Even earlier in 1929, speculation, margin trading, and a loosely regulated stock market created the perfect storm. Ordinary investors lost life savings, yet powerful financiers emerged stronger, buying collapsing banks or leveraging government policies to their advantage. Every crisis is preceded by a period of apparent stability, sometimes decades long. These are the periods when the system lulls people into complacency. Interest rates stay low. Credit is abundant. Asset prices skyrocket. It seems like growth is infinite. People believe they are in a new era, immune to old rules of risk. But this is precisely when the seeds of the next collapse are being sown. The 2000 dot-com bubble was fueled by internet euphoria. Companies with no profits were valued at billions. In 2008, homeowners assumed housing prices would always rise. During these periods, wealthy institutions leveraged the complacency of the majority, positioning themselves in ways that maximize gains when the inevitable crash comes. Eventually, all bubbles pop. The breaking point varies, but it's triggered by a sudden shock, which exposes the fragility of the system. 1929. Falling stock prices triggered margin calls, leading to cascading bankruptcies. 2008. Defaults on subprime mortgages caused mortgage-backed securities to collapse. 1997 Asian financial crisis. Currency devaluations triggered debt defaults across multiple nations. At these points, the illusion of stability shatters. Ordinary people panic. Banks withdraw loans. Governments scramble to respond. But the wealthy? They often anticipate or even accelerate the crisis. Hedge funds, investment banks, and oligarchs frequently short assets or manipulate markets, knowing that the next cycle of consolidation will favor them. Now we reach the moment most crises are remembered for: devastation for the majority, mass unemployment, home foreclosures, pension losses, government debt skyrocketing. But here's the secret: the same actors who benefited from the rise now capitalize on the fall. After the 2008 crisis, J.P. Morgan Chase and Goldman Sachs acquired distressed assets at deep discounts. Hedge funds like BlackRock and Bridgewater expanded influence over government policies and asset management. In essence, the crisis transfers not just wealth, but power. control over resources, influence over policy, and leverage over ordinary citizens. Section 6. Failed fixes, policies that protect the few. After every crisis, governments intervene with bailouts, stimulus packages, and reforms. On the surface, this appears benevolent, but the design often protects the top while leaving the bottom vulnerable. 2008 TARP, Troubled Asset Relief Program, in the U.S. gave banks $700 billion, while homeowners saw minimal relief. Post-1929 reforms created the FDIC and SEC, but largely after wealth consolidation had occurred. Even today, central banks like the Federal Reserve or ECB implement policies that inflate asset prices, benefiting investors more than the general population. The pattern is clear. Crisis occurs, elite capture, policy response, wealth concentration accelerates. Section 7. Modern parallels. History repeats itself. If you think this is history, think again. Data shows the same patterns repeat. COVID-19 economic shock, 2020. Billionaires increased wealth by over 30% globally, while millions lost jobs. Housing and rental markets today are setting the stage for the next inequality surge. Central bank interventions continue to favor asset owners over wage earners. This cycle, crisis, capture, consolidation, has no end unless systemic reforms are implemented. And right now, we are seeing signs of the next wave: high debt levels, inflationary pressures, and unregulated speculative markets. Section 8. 3 key takeaways. Crises are systemic features, not anomalies. The financial system is structured in ways that make recurring collapses inevitable. Wealth and power concentrate upward during turmoil. The people most affected are rarely the ones who profit. Awareness and action are critical. Understanding the patterns can help individuals, communities, and policymakers avoid being mere casualties of the cycle. Section 9. A warning: the next crisis awaits. If history teaches us anything, it's this: the next financial storm is already brewing. Governments, banks, and elite institutions are prepared, not to protect you, but to capitalize. Ask yourself, are you ready to understand the game, protect your assets, and make informed decisions before the next collapse? Or will you wait until the panic has already passed the cost on to you? Conclusion. Call to action. Financial crises aren't just about money. They're about control, influence, and power. Understanding the cycles gives you an edge, but complacency is dangerous. If you want to learn how to navigate these storms, protect your wealth, and understand the unseen forces shaping the world, start by subscribing and hitting the bell icon. We dive deep into history, modern finance, and strategies the media won't tell you. Remember, knowledge is power, but applied knowledge is freedom. Don't wait for the next crisis to learn the hard way.